Hello and welcome to this week's version of Lipper's Fund Flows Insight. I'm Matthew Lemieux. This week we're looking at fund flows again for mutual funds and ETFs for the week ending June 6, 2012. And if you took a look at the performance charts for the markets, especially the domestic markets this week, you really kind of got a little bit of a glimpse at what we had seen last year, 2011, as we saw really quite volatile moves. The market, we saw a little bit of concern, of course, pointing over to Europe, not only just Greece now, but a lot of focus on Spain. But here at home, there was also some data that was really somewhat troubling for investors. We saw that initial jobless claims increased, but at the same time, non-farm payrolls came in lower than expected. So there was a lot of concern in the market that maybe the rally or the growth that we've seen was going to kind of sputter out through the year, something similar to what we saw in 2011 and 2010. So with this concern, again, we saw some fluctuations in the markets, but let's take a look at how that translated into flows. If we actually look at the overall macro groups, we see that roughly $6.1 billion left the mutual fund business. This is excluding ETFs. And of that, equity funds were relatively flat, only about $40 million going out. Taxable bond funds saw about $800 million out. Municipal debt was somewhat the bright spot with $600 million in, and again the big shift in flows was due to money markets with $5.8 billion going out. So as I mentioned before, equity was really quiet for the week, and we've seen that on the mutual fund side for some weeks now. It just seems that investors are somewhat sitting on their hands. There is a little bit of an offset this week. If we go to the equity side, we see of the $40 million out, it was really somewhat of a wash. So taking a look at domestic versus non-domestic. With domestic, we saw outflows about $962 million. And on the offset, we saw non-domestics with inflows of $925 million. For non-domestic, this was the third consecutive week of outflows, and most of those outflows came from the diversified products. On the non-domestic side, this is the 10th consecutive week of inflows. So any investors that are really kind of delving out into equity at this point are really feeling more comfortable with things overseas as opposed to domestic. That's not saying that there weren't some categories within the domestic group that didn't do quite well. Equity income continues to be strong. We saw about $561 million go into that group as investors continue to feel more comfortable chasing yield when they're looking here at home. On the next slide, we're going to take a look at ETFs. Again, this is a slide that looks at the top ETFs by asset types. Overall, equity ETFs saw about $2 billion out for the week. This is the fourth out of 5 weeks we've seen outflows from the ETF space. And of that, of course, it's being really pushed by SPY. SPY this week pushed out about $3.1 billion. While we did see some money coming into interesting groups, it looks like a little bit of the growthier groups, Triple Q and Russell 2000 ETF products, they brought in about $680 million each. So investors are feeling a little bit more comfortable on the growth side, while core and value, however you look at it from SPY side, definitely going more towards the sidelines. The second group we're going to look at is taxable bond funds. This group has really been quite strong over the last plenty of months, and really going back to 2008, we've seen continual flows into bond funds. But this week, we did see about $800 million go out the door, and this is the second time in 2 weeks we've seen outflows. So a little bit of fluctuation there, some seesaw action similar to what we've seen on the equity side. And the real culprit this week, as you can see, was high yield products. High yield mutual funds specifically pushed out $2.1 billion for the week. This is the third consecutive week of outflows for high yield funds, and this week particularly, $2.1 billion was the fifth largest weekly outflow on record for mutual funds in the high yield space. But again, there were some bright spots. They weren't able to really overcome the losses of high yield, but investors still continued to feel comfortable with mortgage funds. They saw about $904 million coming in. This group actually, it's its 27th consecutive week of inflow. So investors are continuing to feel comfortable about the housing market and jumping into mortgages. Actually, this at $904 million for the week was the third largest on record we've seen since we've tracked these numbers since 1992. And investment grade, $178 million coming in as well. So investors that were still going to bonds, they were going a little bit more towards the higher quality products instead of the split we've seen between high quality and high yield. Next, we're going to look at the ETF side for taxable fixed income. Once again, top 8 by assets. And we see that overall it was pretty flat. For taxable bond funds, we saw a net inflow of $176 million. But again, the story was high yield. Between J&K and HYG, we saw about $400 million go out in each one, but overall, the high yields ETFs lost about $830 million. So really investors somewhat shunning high yield. Some of this may be due as a little bit of response to what we've seen as turmoil in the high yield market, whether you associate that with some of the JP Morgan trades or not. We saw some big movements a couple weeks ago, especially in the ETF space. Now it seems that some of that is trickling down to the mutual fund or more of the retail investors. Maybe they're a little bit concerned of what's going on in that sector. The third group we're going to look at is municipal debt funds. As I had mentioned, this really is somewhat the bright spot we've seen for some time now. Investors are feeling much more comfortable about going into the muni debt space, feeling it's a little bit at risk, and the yields still seem pretty good. Overall, we saw about $600 million come into that. The vast majority was into national munis. As a subgroup of that was high yield munis at $182 million. So there still are some investors in that space that are trying to go out a little bit farther, getting a little bit more yield. This was the 8th consecutive week of flows into the muni group. So I think we'll continue to see investors looking in that direction until maybe we see some changes in the market, or we may see something in the elections like we saw in previous years. The last group is going to be money market funds. We said about $5.8 billion out in this group. And again, it's really very similar to what we saw. The net outflows, most of them obviously coming from institutional, a lot of money out of institutional, about $8.8 billion, while retail still continues to see some inflows, about $3 billion. Again, a little bit of a sign towards maybe some movement to risk off in the retail space as investors feel a little bit more uncomfortable with what's going on mid-year this year. Overall, money market funds have seen about $138 billion out year to date, almost matching what we saw, I think, roughly $144 billion out in all of last year. So they continue to struggle to keep assets. So going forward, a lot of the things we've talked about before. Obviously, eyes can continue to be out on Spain and Spanish banks. There was a report out that analyzed Spanish banks, and it was quite stunning that basically they are holding 67% of Spain's sovereign debt. So there's a lot of risk there. There was conversations toward the end of the week that helped boost the market a little bit from Germany and the ECB on whether they were going to come in, help capitalize those banks. We still haven't seen a concrete commitment to that yet, but we'll see how that goes. And I think as we get closer towards the November, I think we'll start kind of seeing maybe some of this election cycle and some of the policymakers. We'll see what happens there. Hopefully they won't come out and cause news that will cause fluctuations in the market like we saw last year with the debt ceiling. If you want a little bit more information about the flows that we've talked about today, you can visit our website. It's www.lipperusfundflows.com. There you'll get an idea of the numbers we're talking about, maybe be able to dig a little bit deeper, unless you want to just come back and visit us next time. So once again, my name is Matthew Lemieux, Lipper Research Analyst, and we'll see you next week.